Every financial story teaches something. Today's story begins with Patricia Delgado. Patricia had excellent credit, the kind she'd built over 20 years of paying every bill on time without a second thought. So when her son needed a cosigner for his very first car loan, having no credit history of his own, Patricia agreed without hesitation. It felt like helping, not borrowing. 8 months later, she applied for a home equity loan to finally renovate her kitchen. The rate she was offered was higher than she expected, and her loan officer mentioned something about her debt-to-income ratio being tighter than her income alone would suggest. Patricia hadn't taken out any new debt, or so she thought. And that's worth pausing on, because it's the detail almost nobody explains clearly before signing. Co-signing a loan puts that loan fully on your own credit report, exactly as if you had taken it out yourself. It counts toward your own debt-to-income ratio. It appears as a new account that can briefly lower your average credit age. And if the primary borrower is ever late, even by a few days, that late payment can show up on your credit too. Patricia's son had, in fact, paid 1 month a few days past the due date, buried under exam schedules. He'd made it right quickly. But the report on Patricia's file still carried the mark. She hadn't missed a single payment in her life. The one that appeared wasn't even hers to make. Patricia talked with her son, and going forward, he set up auto-pay so it would never happen again. She also learned something else worth remembering while looking into her own report. Carrying a small balance on a credit card, something she'd been doing for years thinking it somehow helped her score, doesn't help at all. Paying the full statement balance every month is what actually keeps a score strongest, without paying a cent of unnecessary interest. Her home equity loan eventually went through at a fair rate once the late mark aged past its heaviest impact and her utilization came back down. What stayed with Patricia was simple. A credit score reacts to far more than whether you personally paid a bill. It reacts to debt you agreed to back for someone else, and to habits repeated for years under a misunderstanding nobody ever corrected. Helping someone else borrow money is still borrowing, on paper. Financial protection rarely begins with money. It begins with knowledge. I'm Daniel Brooks. This is American Financial Stories. Knowledge is your first line of financial protection.